Okay, thank you.
A very good evening to all the attendees as well as speaker present here. We at MIT once again welcome you all in the fifth chapter of Industry Connect. Now, it's an honor and privilege to invite Mr. Ankit Jindal, who is an Inspector of Central Tax and Customs and Central Excise Department, Government of India, for enlightening us on the topic discussion on the different financial instruments. The session will broadly cover the following things. Firstly, examine the readiness for investment in the stock market. Secondly, things to know before executing your first trade. Then multiple strategies to deal in financial instruments. And finally, the requirements for generating a safe secondary monthly income. Now, I would like to call upon Mr. Naveen Kaushik, IRO, to welcome the speaker in the webinar.
Thank you, Ayush. On behalf of MIT Meerut and on my personal behalf, I welcome you all along with our speaker, today's speaker, Mr. Ankit Jindal. He will discuss about the differential financial instruments available in the market.
Yeah, thank you, Naveen sir, and thank you, Ayush, for a good welcome. Let me know if some of the participants are still yet to join, or shall we continue with it?
So we can wait for a while, for
Okay.
1-2 minutes, and we can start.
Yeah, that's great.
And another announcement for all the attendees, kindly on your videos for the webinar. Kindly come through the videos in the webinar so that we can have an interaction, we can see the gestures.
And if anybody is having any queries, he can write down his
having issue by coming through video.
question answer sheets.
If you are comfortable, then come by video.
If anybody will be having any doubt or any query, you may write to the chat box. I'll be keep on taking those questions in between. So, and in the end of the session, we'll be having as usual a Q&A session. So the remaining doubts will be taken over there.
Ayush, we can start the session. Let the attendees come and join.
Yeah, if you can get in the session, the participant will join in the short while.
Yeah, that's fine. Okay, so everyone, those who are present right now, you can see a disclaimer over there. So before starting any discussion about the topic, I just want to read this disclaimer on the behalf of each one of you, that this session is strictly for educational purpose and does not provide any advice or tips on investment or recommend buying or selling any stock. I neither take guarantee of profit nor stand responsible for any losses of any recipient. The recipients of this material should take their own professional advice before acting on this information. The recipient is advised to read the information carefully before any investment. So, as I know that most of the participants are going to be students of graduation and post-graduation batch. So my recommendation to each one of you is not even those who are the students, those who are new to this particular topic. My recommendation will be that you just get to know about the topic first. Okay, make yourself fully adjustable with this topic, read properly, learn properly, and then like you should enter about or enter into the stock market or anything if you want to buy or sell any financial instrument. So we'll be discussing about those financial instruments. I would like to avoid that bookish knowledge, though I have included that in the PPT, that what are the bookish definitions over there. But I would like to connect it with the real life examples, which will make the topic interesting, and you will definitely be having that things to know and learn about it. Okay, so the another major question which I usually have about it is that, sir, I don't have any finance background. I am not much comfortable with the mathematics and all other things. So will it be good for me to attend this session or to know about these things, because I do not have in-depth knowledge of the finance? So I must say I am also an engineer. Okay, I have done my MBA. The job which I am doing right now is quite, or I must say, completely different from this thing. And if someone says that I have done my graduation in finance or post graduation in finance, that does not mean that that person knows all about the finance. Finance is a big topic. Like there are many branches. So you, even the person who is having the background in finance, so they must not know everything about the finance. Okay, and in day-to-day basis, we usually deal with the financial instruments, but we usually don't understand or try to learn that thing, that it can generate some type of secondary income for us, or how these instruments can be helpful to us. So in-depth knowledge about finance, that is not at all required. You just know about the proper method that using which you should enter into this market, and what are the roles and what are the features of different instruments available in the market. Okay, so this is what the definition from the International Accounting Standards, which says that financial instruments is any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. So now it becomes too much complex. The moment we read this definition, okay, so we usually prefer that something standardized thing we should need to read about. So it makes too much complicated for us that we usually skip at this point to know about this topic. So what will I try to do in this session? In this session, I would like to unbox those things in a very simple words, so that we must generate our interest toward this side. And after having proper knowledge and after spending too much time to experience all the things, then we should enter into the stock market. I'll just give you an example of this thing. Let me take you, rather than coming on to that side, I'll just give you an example. Let's suppose there is some person who is, or I must say, as our participants, most other students. So let's take this example that some student is there who is studying finance or who is doing MBA, and now that student is looking for a job, okay, in future in the same segment. Okay, but in during the course, okay, the person is, that a student is more inclined toward the stock market, or they just want to invest in mutual fund or somewhere else. So what students usually do, they have a capital of 5,000, 10,000 rupees, 50,000 rupees even, and without having proper knowledge, they just want to make this multiply. Like if they are having 10,000, so they feel that if we put this money in the stock market, will get 20,000 return, 50,000 return. So that is what the major problem there is. I am not saying that this is not possible, but for making 10,000 or 20,000, 50,000 in one day or in a week or in a year, so that is, there should be different type of knowledge and the practical learning you should have for that. So let's suppose if I take this in a simple words, let's suppose I'm having a capital of 1 lakh rupee, and if I invest that into stock market, So what should be my expectation from the stock market? So my expectation when I am going to stock market, every one of us has heard about this, that stock market is very risky. Okay. So that is fine, because everything which is risky will give you more return. Why are we moving to stock market? Because we know that there are high chances or high probability of giving the higher return from that particular segment. So if you are getting higher return, so definitely there will be more risk. So if I'm having 1 lakh rupee capital and I go to stock market, I know this very well, that there are high chances of losing the money also. But if I'm the person who is not ready to take the risk, so then what are the different instruments available with me which I can do with that? So if I am a very conservative person, that I don't want to lose my money, what will I do? I'll keep the money in cash form along with me. So there will be no increment at all, and there will be no depreciation at all in the form of money until it is stolen by somebody. Correct? So in that case, I can lose my money. So there is probability of losing the money, but the chances are very low. The another thing which I can do is I can keep my money in the saving bank account. So in the saving bank account, the probability will increase a bit. For example, if I take an example of Yes Bank, okay. So if somebody was having his money or her money in Yes Bank, in the saving bank account, so recently we have seen that the management got failed about in Yes Bank, and many of the investors were worried about their capital over there in the saving bank account also. But there are less chance of losing your money in comparison to the stock market if we take the comparison. But what is the return in saving bank? So saving bank, the annual return is 3 to 4%. If I just talk about the real scenario, so if you invest 1 lakh rupee, you will be getting 3 to 4,000 more at the end of the year. Now I think I just want some more. Okay, I want more gain than 3 to 4,000. Then what are the different things I can do? Some people will suggest me you can go for a fixed deposit. So what was the liberty I was having in saving bank account, that I can take my money back at any moment whenever required. But in fixed deposit, I'll be getting a return of 6 to 7%. Okay. But the problem is my money will get blocked for around 3 months, 6 months, or an year, or 5 years, whatever tenure you have selected over there. But now the risk has become more, because let's suppose after 2 months you are in need of your money, but your money will be blocked in that fixed deposit and you will not be able to withdraw that one. But there you are having some high return. So that's why the probability, let's suppose the bank has some issues and the money of the investor got reduced from there. Yeah. Or there are chances that the bank gets closed. So in that case, your money will be gone in zero case, or like after few years when the management is up, then you will get your money back. So there are slightly more chances of losing your money in comparison to saving bank. So we can see that when we are increasing our risk capability, we are getting the more returns. Now there will be people who will be suggesting you that if we talk about our second generation, or like our parents or grandparents, they would be advising you that if you are having some capital, you should go to the market and you should purchase some property, some land. Okay. And there after 5 years or 7 years, you will be having a good capital return from there. But that is not possible in today's scenario, because we are in the 10th generation. We are in the 10th generation of that thinking, that if I buy some property today and after 10 years, it will become double. Okay. Even if you want to make your money double, that can be done in the FD return also. So like if you put your money in fixed deposit, after 8 to 10 years, that will become double. So now most of the people of our generation are working in different cities, even in different countries. And if let's suppose I buy some land in UP or in Maharashtra or in Karnataka, so after few months or years, I will not be there at the same place. So who will be taking care of that particular property? And you know that there is a downtrend in the property market. Okay. So in the real estate sector. So those things keeps us away from that. So now people are there, sir, should I go for FD? So as I told you that for the FD fixed deposits, the return are lower at this year. Okay. And they maybe become lower because of the pandemic, which we are seeing at this time. So many of the students and many of my known my friends, my colleagues, they used to keep on asking me that in this particular scenario, should I start investing in a stock market? Because I heard that in March or April, the stock market was very down. And now everyone who invested in March or April, they are getting 100% return in just a period of 3 to 4 months. The stocks which were available at 1000 rupee in April is now at 2000 rupees. I just take an example of Reliance. I just take an example of Infosys. Okay, so Infosys stock was available around 4 to 500, but now the current market price of Infosys is around 950 rupees. But when we used to know about this news, okay, so already the increment has been done, because being a retail investor, when we get such type of news, already the stock has made that momentum that it has become double. So now if you put your money in Reliance, okay, or in Infosys, there are very less chance that you will gain something from there. It may happen that in next 3 4 months or in a year, the stock may fell down. But if you have a vision of 5 years or 10 years, then definitely the return will remain same, or you will be getting the 1000 rupee stock may become 2000 or 5000 or even 10,000 rupees. That depends on the company's performance. So how to choose a particular stock is very important. Okay, being an Indian, okay, whenever we go to market, we usually look for the bargaining. Okay, we always wait for sale. Okay, so let's suppose if we are going to buy some vegetables in the market, what we usually do, we ask that what is the price of this vegetable. Okay, what is the price of that, just give me some percentage of offer over there. And if you, let's suppose your target is to buy three vegetables today, it may happen that you will buy two today, and you will be looking for a lower price for tomorrow or day after tomorrow for the third vegetable. But when we go to the stock market, what we do, that we are ready, that we are in that fear that that price of this particular stock will never come down. So we are in a hurry that we buy some particular stock at the higher price. And then that becomes the difficulty for us, because then the price will come down and we will be in the problem that either to sell that stock in loss, or shall we wait for some next, I must say, for 1 year or for 6 months or even for a longer time to be in a profit again. But we need to understand that there is a time value of money. Let's suppose if I block my money in some particular stock, okay, for an year, so it will become difficult for us to gain some like required result over there. So what happens, people come to stock market, okay, having a thought that I want to become a trader, correct? And what is the job of a trader? The trader buys something at lower price and sell at a higher price. That is the job of a trader. So trader comes into the stock market with a vision that I will buy something at a lower price and I will sell it at a higher price. Now that trader will have to decide the tenure of this proper transaction. That the person may be in a view that I buy it today at a lower price and I'll sell it today at the higher price. If the price is not coming higher even today, I will sell that particular stock in the lower price where I will be in loss, because the person does not, that trader does not want to block his capital, okay, into the stock market. So this is what, where the trader is having the very low tenure, okay, I must say very low vision, where they have this, I will sell the stock in the same day, on the same day. Those are called the intraday traders, correct? I'll just giving you a brief introduction about all of these, that what type of vision, because our mindset is in that form that people usually come into the stock market having a view of the trader, but because they don't take the right call and they become the investors. So there are traders who used to cover their position in a single day. There are many traders who used to cover their position for 1 day, 2 day, even for a week or for a month. So these traders are called the short-term traders, okay, where they keep their money blocked even for a week or for 1 month. There are some, I must say that mid-term traders who used to keep their money blocked for even up to 3 to 6 months. Let's suppose they buy some stock today, having some analysis about the stock or the company, and they feel that after 2 to 3 months, the price of the stock will become 10% or 20% or even 30% higher in a period of 6 months. So they hold that particular stock for next 3 to 6 months, and then they cover their position. even if they are having profit or loss, that depends what analysis they have done. It may have happened that, let's suppose the price of some stock is 100 rupees today, and I feel that after 3 months the price of this stock will become 130 rupees or 140 rupees. So I wait for 3 months, but I have decided that I should not, I don't want to be in this stock for 2 years or for 3 years or for 5 years. So what will I do? I'll keep ready one stop loss. Okay. That stop loss means that I want to loss, or I want to stop my loss. How is that being used? That I will set my stop loss according to my analysis. That may be 90 rupees, that may be at 80 rupees. That in this 3 months period time, if the price of the stock go less than 90 rupees, so I will sell my stock. Okay. If the price of this stock goes less than 80 rupee, I will sell the stock. I'll exit from there, because my capital, whatever I have involved over there, what 100 rupees I have put in that particular stock, I want to save that one. Okay. There are many scenarios. You might have seen that the companies which were trading at 1,000 rupee price, okay, the stocks for some companies was 1,000. Now those companies are in just 2-digit number, less than 100 rupees price they are having. And some are there which are having just 3 rupee, 4 rupee, or even those have become the penny stocks. Okay. So I don't want to block my capital in a particular stock. So that decision has to be taken. So that either you are going in a view of a trader, or you are going for a view of an investor. So that much analysis is to be done initially when we are going to the stock market. That if your view is clear that you want to become an investor, so you should put your money even then, not at the higher prices. Let's suppose I am having a view that I'm having 1 lakh rupees and I have no need of this money. I can invest this money for 5 years, for 10 years, for even 15 years. After 15 years, I'll take this money out from there. So if I want to invest that 1 lakh rupee for a period of 5 to 10 years, it should not happen that I should buy anything. Okay. I should have that much knowledge to buy some stock at a right price. Let's suppose if I take an example of Reliance. Okay. The current market price of Reliance is, let's suppose, 2,200. Okay. That's near about 2,300. I'll take that at 22 or 2,300. So because people have seen, if you look at the chart of the Reliance, in last 4 months, there is a rally. The price has become from 980 to 2,300 rupees. So will it be good to buy some stock at the higher level? Okay. There may be chances, if I am feeling that this price will go up, I may even buy that stock at the peak. Okay. But when I am a long-term investor for 5 to 10 years, I will wait for the right price, because I don't want to in and exit from the particular stock. I will wait for the right time. So I'll be having the view when the price will correct up to 2,000 rupees or 1,800 rupees or 1,600 rupees, then I should enter over there. When I take the example of TCS, so the current market price of TCS is somewhere around 2,200 rupees right now. So when will I be, or when will I find to enter into that particular stock? When the price will come at a right, or I must say at the adjustable rate. So I should enter the trade at that particular time. I should not be in a hurry that if I'm having 1 lakh rupee and someone suggested me, you buy this particular stock, that should not be the thing. Otherwise, after 10 years, obviously there are chances, if you have put your money in a good stock, you will be getting higher returns, but not that much higher, which you will gain if you had invested your capital wisely over there. So this is another thing that you will have to keep your idea clear, whether you want to become an investor or a trader. Correct. So when I think that I am an investor, I will block my money, or I will put my money for a vision of 3 years, 5 years. It would be more than 3 years. So sometime you will be having 5 years view, you will be having 8-year views. So what are the different instruments I can have for that? So you can go for FD for that particular thing, fixed deposits, but you will be seeing in the current market scenario, so that the rate is not that much good, which used to be there earlier. So what will you be doing? Either you put your money in the saving bank account, okay, for the shorter period term, when you feel that the returns of the FDs or the fixed deposit has been good, then you take your money out from the saving bank account and put that money in the fixed deposit. What will happen? It may take 1 year or 2 years, but for 2 years, initial 2 years, you will be getting lesser return. But if I put my entire money in the fixed deposit right now, whatever is the rate today, that will be taken forward for that tenure which I have set for that particular fixed deposit. Correct? So it may happen for the first 2 years, I'll not be getting that much good return in the saving bank's account. But when the prices or the interest rate of the fixed deposit will be up, I'll shift my money from saving bank account to the fixed deposit. Okay. Now people think that, sir, I just want more return from even the fixed deposit. Let's suppose the fixed deposits will give you 7% return or 8% return. Should I invest that money into gold? Okay. Or should I invest that money into the mutual funds, because that is what I have heard on news or in TV, that there are mutual funds available? Or should I put my money into the stock market? So what will happen? Usually for mutual funds, the return are from 10 to 12%. Okay. And there are different type of mutual funds. So first we need to understand that which mutual funds you are choosing. Okay. It should not be that you just listen from your friend that I have put my money in this mutual fund last 3 years, and now that money is giving me 20% return on an annual basis. So that 20% that person has already gained. Now after looking at the past 3 years result, you start putting your money into that mutual fund. So that will be a backfire for you guys. Okay. So in mutual funds, I must say that if you are an investor, definitely you should go through the mutual fund route, even if you are not from the finance background or you have no knowledge about the stock market or anything. Because when you invest in a mutual fund, there is a mutual fund manager who takes, I must say, who take care of your investment. And whenever there is some stock who is not performing, they used to change the money from the bad, I must say, bad stocks to some good stocks. So mutual fund is what? A basket of stocks where there are 10, 15 or 20 or 30 stocks, which the fund manager used to choose. And they put your money in that particular stock. So let's suppose if a person is there who is having just 2,000 rupees, and that person wants to buy a share of Reliance. So as I said, the current market price of Reliance is 2,300. The person will not be able to buy that particular Reliance share. But if I go through the route of mutual fund, so in that mutual fund basket, the manager may be having Infosys, Reliance, and I will not be the only customer for that mutual fund. There will be 100 or 1,000 or even lakh investors who will be investing. So my money will be invested in the same proportion. Okay. So my 2,000 rupees, out of those 2,000, it may happen that 100 rupee will go to Reliance, 50 rupee will go to Infosys, and that proportion will be managed by that fund manager. So your fund manager will be taking care of your fund. So you can invest with 2,000, 3,000, 5,000, even 500 rupees, some of the mutual funds allow. So if you have no knowledge about the stock market, still you feel that, no, I want to gain something from a stock market. I am having that passion that I want to make some increment. I will suggest that you should take a route of the mutual fund, talk to your financial advisor. They will be suggesting you something. But for that also, if you will be having some knowledge at your end, that will be good for you. Okay. That which type of mutual fund is that? So there are two type of mutual funds. Okay. Initially, which we think about, first is equity based. Another one is debt based. So debt based is when company gives loan to some another company, and the company will return a fixed percentage of interest. That may be 9%, that may be 10%. So there are very less chance of loss. Okay, let's suppose I invest my 1 lakh rupee. So I'll be getting on an average 9 to 10% return on an annual basis. Okay, that may be, if the market is performing very well, that 9 to 10% will become 10 to 12%. Okay, or if the market is not doing good, so that 9 to 10% will become 8 to 7% return. But I will be gaining something. My 1 lakh rupee will remain intact over there, and on that I'll be gaining something. Okay, that is what the debt mutual fund. The another one is the equity mutual fund. Equity mutual fund are more volatile. If the market is doing good, the mutual fund will be doing very good. Okay, but if the market is crashing, so your 1 lakh rupee may become 50,000 also. So your capital will not remain same. So whenever you are taking a route of equity based mutual fund, you will have to be very careful that in which situation you are putting your money in. So if any one of you are tracking the stock market currently, I'll take the current scenario. So in February month, okay, our Nifty index and the Sensex both were there at the top. Okay, so if I had invested my 1 lakh rupee in lump sum means the whole entire 1 lakh rupee I am investing in a mutual fund. In, let's suppose I have done that in the month of February. So in March, the market crashed down around 40%. Okay, the Nifty came from 12,000 to 7,500. Okay, so if I had invested my 1 lakh rupee at that moment in month of February in equity based mutual fund, that would have become how much? That would have become around 60,000, 75,000, 70,000. So that much. So my capital had reduced. And if let's suppose some of my friends, okay, or if I talk about Ayush sir, so Ayush sir would have invested 1 lakh rupee in month of March after the Nifty had corrected, after the stock market crash. If somebody has put 1 lakh rupee in month of March end or in April, when the Nifty was at 7,500 level, now after 2 months or 3 months, that 1 lakh rupee would have become 1,80,000 or even 2 lakh, because now the Nifty has again come from that 7,500 level to around 11,500 level. So that is what you will have to keep the market. You will have to track the market so that when the Nifty is corrected or when the indexes are corrected, when the stocks are corrected, they are available at a cheaper price. Then you put your money in equity mutual fund in a lump sum. Okay. Otherwise, if you are the person who is involved in your job, okay, and for tax saving also, for tax, we used to pay tax whatever we earn. So there are some procedures or through which we can save our tax. So for that, we used to do some investment. So if you are investing in mutual funds for the purpose of tax saving benefits, so I would suggest that you should go with SIP, systematic investment procedure. Okay, so with that you can invest 5,000, 2,000, 8,000 rupee per month. Okay, and you should keep continuing it so that whenever the market is available at the cheaper price, you will be buying at the cheaper price. When it will be at the moderate price, you will be even buying at that. So over the period of time, whatever you are purchasing from the stock market through the SIP, okay, you will be getting an average price. So in a long term period of 5 years, 10 years, or even 15 years, you will be having a very good return. And in parallel to that, you will be availing the tax benefit also. So these are the two type of mutual funds. So when you are having this idea, sir, I should go into the stock market, okay, with this view that I should gain very good result from there, that is possible. That is possible over there. But you will have to be very wise in that particular knowledge that whether the stocks are available at the cheaper price or not. So now many of you will be thinking of, sir, that there is one stock, RCOM, okay, Reliance Communication, which is available at 1 rupee or even 2 rupee. Okay, so shall I buy that one? Because you said that we should buy the stock at the cheaper price. Okay, if you buy that at a cheaper price, you will have to look for the company also, that which company you are investing in. So I have said that in the last 10 years, the chart of the Reliance Communication is going into the downtrend. The stock has become 2 rupee from 100 rupees. So if the company was good, okay, it would not have dropped down this way. So you'll have to buy, or you will have to choose that particular company which is having good potential, okay, where the chart is going in the upward direction. So how to select a particular stock? In a nutshell, I will just try to define this way. The proper way of selecting a stock, that which stock we should invest in, is first we need to do the fundamental analysis. Okay, that for a particular company, we should need to know that what is that particular company doing. For an example, if I take the example of Britannia, okay, so the stock of the Britannia is listed. I look at the chart. Okay, if you look at the chart of the Britannia, currently the price of Britannia is 3,400 rupees. Okay, in many a times the price, you will see that the graph is from lower to up. Okay, it is going up in a longer period of 10 to 15 years. There was no downfall even for any time, correct? No major crash was there. So that company, we know that out of, like, I must say that in every house, we use any product of Britannia for sure for our breakfast or for any another purpose. Okay. And the company is known to everyone. So there is a good business for this particular company. Okay. A big company. You will have to see the different financial ratios, whether the company is having some type of loan on this, okay, or not. So that is checked with debt to equity ratio. The equity is the capital which company itself has infused in their business, okay. And that is what, when the company has taken loan from bank or from some another institution. So if some company is having good business, okay, that is the first thing we should need to take on. The another thing is company is having loan on it or not. So if company is having more than 50% loan, let's suppose I start a company with 100 rupees and then I take a loan of 50 rupees from the market. So I'll check what the debt to equity ratio, if that is going more than 50%. So I just try to avoid that particular company. That is my view. Okay. That company should not have too much loan on it, because when the debt time will come, the company will have to return the debt also. So that is another criteria you will have to look on. And there are different type of ratio. What was the high price? What was the 52 low price? Okay. What is the daily volume? That how many people are buying on daily basis this particular stock. That will help you to gain the idea that how the fundamental analysis. So somebody will say, sir, should I have a proper knowledge about the finance again for do the fundamental analysis? That is not important. You just need to know that what is the current market value of the company. Okay. What is the quarterly? You should even just to know about the like profit and loss statement. Okay. The quarterly statements and the annual statement, where you come to know that how the revenue of the company is increasing, how the annual profit of the company is increasing, or the profit of the particular company is going down. Let's suppose in 2018 the company was having a profit of 200 crores. Then next year it becomes 250 crores. Then next year it became 400 crores. Okay. Then I'll be thinking, yes, this company is good, so I should not have that much financial knowledge again. I can just read the number whether the company is going up or going down. If there I see that company is very good, but the revenue is going down, so there may be some reason. For example, this year you all have seen a major crash in the market. So the revenue has dropped down around 80% for many companies. I talk about the automobile sector. So the production and the supply of the cars or the two-wheelers have stopped for 2 to 3 months when the entire lockdown was there. But when I talk about the Britannia, so the supply for the essential products were there, so their sales has gone up. So these type of different analysis you will have to do. After doing the fundamental analysis, you will left out with some companies that I should invest in these particular companies. Then after that, you will have to do the technical analysis. In technical analysis, as we discussed earlier, that either the stock is available at the right price or not. You all have seen that the price of the stock never goes in a straight line to up. Okay, I'll just draw it for you for a second. So whenever you see that or you look at the chart of a stock, so the price of the stock never goes like this. What happens if you look at the graph? So the price of the stock goes in this way. Okay, if some company is going very good, it may be doing something like this. So when I see that the price was increasing, okay, I will not buy that one at that price. I should wait whether the price is being corrected or not. So how will I come to know that the price will return up to this level or it will turn from there itself? So by doing the technical analysis, you will come to know that this is not the buying price. Okay, this is not the buying price. Even if somebody has bought at that particular price, they should wait for the, I must say, this is called the swing. Okay, when you read more about the stock market. So buying the particular stock at the right price is very important. For that, we need the technical analysis. Okay, so first you need to do the fundamental analysis, then you need to do the technical analysis. So, but somebody says, sir, I am not having that much time. I am earning well. Okay, I'm not having that much knowledge. So I must say that when you are choosing some financial advisor, when you are taking help from some financial advisor, they will be doing this job for you. But at least you should have some knowledge about the stock market, which company they have chosen. Okay, you would be able to, because if you say, sir, I am studying HR, I am studying marketing, okay, or I am an engineer, I have no knowledge about this. But my idea is that after 10 years or after 5 years, you will be earning well, where you would like to invest some of your money in some of the financial instruments. So that time, I must not say that you study stock market, okay, but you should have some knowledge that where is your money is getting invested. So that you can talk to your financial advisor at some level that where you should need to invest. Now, these are the basic things when you need to buy the stock, okay, or when you not need to buy that one. Then there comes a picture in this thing that people used to ask that, sir, you said that there is uh, another thing where we can buy, or we can have a secondary parallel income, okay, where we just need to put our capital in and we need to sit for that. That is to be done through the financial derivatives. Okay, I'll just give you an overview about the financial derivatives so that you should learn about that. That is again not a, these topics are also, which I said, that fundamental analysis, technical analysis, and the derivatives, financial derivatives. These topics take 10 hours, 15 hours, 20 hours just to understand properly. Okay, so after that you will have to practice these things, then you will be able to what, gain something from there. So when we talk about the financial derivatives, so I'll just give you an example that what does a derivative mean. So derivative mean like uh, derivative in simple words is anything which derive its value from something other. Okay, something other, that can be anything. For example, we all use credit card or debit cards, okay, either ours or our parents. Okay, so along with that debit card or credit card, you get a separate account, okay, or a separate card, which is called the payback card. In that payback card, you receive some points, okay, from there you are getting those points. Let's suppose if I invest 100 rupee from my credit card, I'll get 2 points in my payback card. So that payback card has become your derivative. Okay, and from where its value is being calculated, it is being calculated from your credit card or debit card expenses. If you expend, or if you I must say that expense more from your credit card or debit card, the payback points will also increase. So the payback points is not having any initial value from themselves, but how are you earning these points? From the credit card expenses. Getting? This is very simple. Another thing is, I just take the stocks itself. How do we decide the prices of the stock? That the Reliance stock is currently now 2300. Earlier it was 2000, then it was 1000. How that price is being decided on daily basis? So that is being decided on the demand or supply of that particular stock. If the product is in high demand, so when the demand increases, the value of that particular derivative will increase. If the demand decreases, then the price of that particular derivative will decrease. So these increase and decrease are used, okay, these derivatives. I will not be able to explain that in just 5 to 10 minutes here. So that is what the derivative. On the help of that, I'll just let you know that what you need to search on Google or YouTube, so that you will be getting some idea. You connect me on LinkedIn, so that later on, if you will be having any query over there, you will directly connect to me. So you just search for option writing. So when I talk about derivatives, so there are different type of derivatives in our stock market. Okay, the important derivatives are future derivatives and the option derivatives. In future derivatives, that is a separate thing. Okay, in option derivatives, there are again two type of derivatives. First one is put option, another one is call option. Okay, so these three things you just need to read on. Okay, and that will definitely, you can connect me on a regular basis. So that derivatives will help you definitely to gain a secondary income. I usually earn from there. Okay, but how to earn that, how much capital? So I'll just give you a rough idea that when you go for option writing, you search this keyword option writing in Google or on YouTube, you will get multiple videos, but that will just give you some idea before investing in options. Okay, before trading in derivatives, you just need to learn more. I must suggest you that at least 6 months you need to practice those things on paper. Okay, don't like after going through one video itself, you will be fascinated about that I have found something good and I have no need to study about, I can earn in crores from there. Okay, it seems in starting, but I will suggest you that don't be in that way. You just study for 6 months, for an year at least, do the trading on paper, write the value, see either you are getting correct or not. Okay, in your judgment, because many a times I myself go wrong. Okay, but that derivatives give me up an opportunity, even if I go wrong in my analysis, that supports me at a certain level. Okay, so for minimum requirement, when I go for the option writing, my requirement will become at least 60 to 80,000 to 2 lakh rupees. Okay, that much capital, I must say at least 70, 80,000 if I go for option writing of stocks. Okay, there are index option writing also, which will allow you to write the option in just 3,000 rupees, 5,000 rupees, 10,000 rupees. You might have heard in news that a kid has lost 10 lakh rupee of his parents in just one day. How is that possible? That is possible through the derivative. So that's why I'm telling you those are very risky instruments, but risky because people don't study them properly and start applying those in the real market. That's why it become very risky. Okay, you just need to learn those first at a good level. That will be very helpful. So these are the different instruments in the stock market which are available. So the first one is, I must say that we talked about the bank FD. Okay, the saving bank account. So overall, what I'll just talk about for deriving any financial instruments, and when we look for the gains. Okay, why are we choosing different financial instruments? That we are looking for a capital gain. But my idea when I choose any financial instruments for any period of time, I see that my capital should be preserved over there. Okay, let's suppose I am starting with 1 lakh rupee. It should not happen that over the period of time, this 1 lakh rupee has just become 20,000 or 50,000 rupees. I just focus on my capital preservation. Okay, it may happen that, as I told you, that I will be having one stop loss in my hand or in my mind, that I should cut my losses at 10,000 rupee or 20,000. That means this 1 lakh rupee I can wait up to 80,000 rupees. But below that, I will not wait. I will keep my money out from there. So capital preservation is the, I must say, the first important point which you should have in your mind. Okay, so different instruments which we talked about were the saving bank accounts, the FDs, the mutual funds, and then the stock market, where we can invest directly in the stock market at our own. Okay, while having the demat accounts. The next thing which we are talking about are the financial derivatives, which is the, I must say that, as I said earlier, that we are in the 10th generation of what? The real estate market, that we have stopped buying and selling the properties right now. So on that analysis, we are the seventh generation of this fixed deposit or the FD things. Our parents, grandparents used to invest money in FDs because that time the returns were much higher. Now the returns are lesser. Then the term came the mutual fund. So we are the fifth generation of mutual fund investments. So right now that is a good option to invest because we get a decent return from there. On an annual basis, we get 12 to 15% or sometimes 18% return. But that is to be invested for a longer period of time. But when I come to this financial derivatives, so we are just the second or third generation of financial derivatives. And this is going to be a, I must say, future for next few years, which will give you a higher return or good returns when you are directly investing through financial instruments. So that is what the best instrument I must suggest all the students and all the participants, okay, that you should understand that well. Okay, so Ayush, I must say that we should have their queries first and let them put their doubts or queries which they want to know. Okay, Rajni Pandey has asked, which is a better way of saving, stock market or bank? Uh, Rajni, as I said that banks, okay, a stock market. I must say both are a good way of saving, but it depends on your tenure. Like when you go into the stock market, I'll just take an example. Let's suppose I invest in some stock which is of 100 rupee right now, and I want to stock market with a view that I take my money back after 2 months, or I want my money back after 2 months or 3 months or any year. Okay, let's suppose the current market price of some stock is 100 rupees. I invest my money in that particular stock. Let's suppose after 3 days, the price has become 105. So in just 3 days, I am getting a gain of 5%. Either I can book my profit at 105 and I will be out from the market. Okay, but you have that idea, no, this stock will go up to 150 rupees in just 6 months. So let's suppose the price come to 110, then 120, then started going down again, as I showed you in the graph also, that the price never goes in a straight line to up. Okay, it may go back also. So now if the price has become 90 rupees, let's suppose after 3 months, and then the price remain there over next 2 to 3 years or even 5 years, so then your money will get blocked over there. So if you are having a time horizon of, let's suppose, 2 years, 3 years, 5 years in your mind, if you are having some money which is of no use for you at particular time period, so then that money you can put in the stock market, because stock market never gives you a certainty or any time duration that after these many months or after these many years your money will become double, your money will become zero also. Okay, or your money will become 10 times also if you have chosen the right stock. While in bank, if I had put my money, I know that my money is safe, my capital is safe. Let's suppose if I require that 1 lakh rupee after few months, so I'll get that money immediately from there. So it's completely on your requirement. If you are having some capital, let's suppose I am having 50,000 rupees. After making all my savings, still I am left with 50,000 rupees, and I can take risk on these 50,000 rupees. Then I can put this money into the stock market. And directly again, I'll not be going to the stock market to take that thing that I will buy this stock or that. Take the proper financial advice that which stock will be going good. Okay, even if you are not very sure about that particular stock, so choose the way through the mutual fund. So where the fund manager will be there, he will be guiding, or that fund manager will be putting your money into the right stock, and that person will be taking care of that. So for fund managers, when we invest through few mutual funds, we usually pay the expense ratio, okay, 1 to 2%. Okay, every year we used to pay from our earnings, whatever we are earning from there. So that is fine if I am not having that much time, that much knowledge, but I want to earn from a stock market, so definitely I should take the view or route through the mutual fund. So I hope I answered your query. If you're still having any other, please type in over there. If anyone is having any another query, just let me know. Suresh is asking where to invest money in, short or long term. So again, Suresh, as I earlier said, that you will have to make that idea very clear in your mind. Okay, either for the short term. So when I say short term, for some purpose, some person short term may be 1 week. Okay, for some person short term may be 1 year. Okay, for some person long term may be 10 years. So when I see that I have invested my money for 10 years, then you should not to be worried about on daily basis that I am looking my demat account on daily basis. Now the value has become less. Now the value has become more. When you have set your time period for a long term, okay, I must say in a longer period of time, you should definitely invest in equity mutual funds. Okay, if you're having good knowledge about the stock market, then definitely you can choose some of these stocks at your own, which are fundamentally correct, which are the blue chip stock, which are the part of Nifty 50. You can choose those stocks, and you can invest your money over there for a longer period of time, for 5 to 10 years. Okay, still you want some security, I will suggest you to go through the mutual fund. And if you are a new person, you should go through the index mutual fund. You can write that name, index mutual fund. What that fund usually do, that your money will be invested in the index. That can be Nifty 50 index, where the top 50 stocks are there. Your money will be put only in those 50 stocks, and your fund manager will be managing that stock. So if the Nifty 50 is going up, okay, so your money will be going up. If the Nifty 50 is going down, your money will be going down. But you might have observed that the indexes usually go over a longer period of time in the upway. When the Nifty 50 or the Sensex started, they started with just 0.100, okay, and now they are in thousands. So after 5 years, definitely whatever is the Sensex now, that may be, let's suppose I must say that now the Nifty is at 11,500. So after 5 years, it will be definitely somewhere above 15,000. That may be 20,000 also. Okay, so for a longer period of time, you should choose for the mutual funds. Okay, if you have sound knowledge at your own, so you can choose some good stocks where you can do SIP also. So again, Suresh, I must not name you any stock over there. You can choose some of these stocks from the Nifty 50 index itself. Okay, let's suppose you can take L&T. Okay, you can take Infosys, TCS. First, you look at the sector wise, that which sector is going to perform well. You must be hearing this news everywhere about the banking stocks, that the banks are not doing good right now. Okay, banks are going to sink. The prices will go down for banks. Already the bank stocks have corrected too much. So now if I say that you should invest in banks, so then you will be thinking about which bank stock, because there are many. So what we usually people do, they choose those stocks of banks which are at 10 rupee, 15 rupee, 100 rupee. You will be choosing the Bank of Baroda, you will be choosing the Dena Bank, Yes Bank. Okay, but you should choose that particular good bank stock, okay, which were doing good in the previous thing. So I must say that you should choose which stocks of bank. You can choose Kotak Mahindra Bank, you can choose ICICI Bank, Axis Bank, even SBI also. So those banks are going to help you. So if I start SIP in the Axis Bank or in the ICICI Bank, that will give a good return to me after 5 years or 10 years when you are having a longer period in your concern. So again, I must suggest you that don't blindly follow my views. Take the help from your financial advisor. But when you are having a long-term view, the SIP in the mutual fund or SIP in the stocks, which are the blue chip stocks, will help you definitely. Anyone else?
Well, I think Ankit, you have answered all the questions, all the queries being asked by the attendees. Anybody else who wants to answer, they can write in the chat box. Well, now I would like to call upon Mr. Vishwas Gautam to give a vote of thanks to the speaker.
Thank you, Ayush. Thank you, Mr. Ankit. I can't see you. I think your screen is off.
Maybe we will do issue, sir.
Okay. Thank you, Ankit. In the days we are currently living in, and with the economics going all drums, uh, you giving such insightful talk is kind of the demand of the day. So I deeply am grateful. I thank Ayush for inviting you. I thank Naveen sir for assisting us. And as we say, because this is such a deep topic, uh, and one lecture won't be enough. So if you have time, we would like you to revisit us. Uh,
Yeah,
Mr.
thank
Ankit,
you,
if you
sir.
can hear me.
Yes, sir. Yes, sir. I can hear you.
Because as we all are aware that for the way economics and the economy is going, we have to be extremely intelligent. And I read your disclaimer also that which aptly puts that how intelligent one must be when it comes to investment, when it comes to finance, when it comes to numbers, for example.
Yes,
People are
sir.
very bad with numbers, and it was very insightful. But the fact remains, there's so many. I was just going through a PPT. Each PPT has so many layers inside it. So if we take each presentation slide of yours, is a topic in itself. So,
Yes,
so,
sir.
so that way, I would request you that please take out time once again and do revisit us, because the topics that you touched upon, each of the topic is so deep that your expertise
Correct.
can guide us better and can guide not only the faculty members but the kids who will now
Correct,
get
sir.
into the industry and decide. For me, I think for a young boy like you who knows the numbers, who knows the industry, it is a responsibility of you to guide the kids, because the moment they get into uh, earning money and getting salaries and everything, they don't know how to go about it. And
Correct, sir.
most of us even in the jobs, we don't know that how can we save, what is the way to go about it. And at the end of the day, we end up getting duped or losing it all. So
Correct. Sir, our focus usually remain on earning that we should get a package of 10 lakh, 20 lakh, 50 lakhs, but we hardly talk about where to invest that money, how to preserve that particular capital which we have gained throughout the year by working hard. So that becomes very difficult for
absolutely,
everyone.
that
So
which is
I
which is
am,
what
yeah,
which is what I was talking about. That one, we don't know where to put the money, and two, even if we put the
correct.
money, we end up wasting it. So
Yes,
the point remains. I will request Ayush to once again invite you, and do let people know about the SIP and the mutual funds, and how they can save taxes, and how their money which is hard earned can be saved. Because lot of us, even including myself, we don't know that there are certain things, certain ways
yes,
that we
sir.
can save money, our hard earned money. We end up losing it
Correct,
through
sir.
taxes, and wherein we can invest that money in proper way. Also, we get lured by some companies giving ads which talks about profits in short term, which
Correct,
are very dangerous, because you you just get into the trap, you invest money and you end up losing it all. So
correct, correct, sir.
all these things are very important. I will request you to please come back again and touch these
Definitely,
topics.
sir. It will be an honor for me. Don't
Honor is
say
all ours.
again and again
Honor is
any,
all
yeah,
yours.
request. Yes, sir.
And the credit goes to
Yes.
Ayush for once again bringing a intelligent and bright young boy like you. We are very grateful. I thank Naveen sir also for being there and guiding us through it all. And
Thank
Ankit,
you.
as I
Thank
said,
you.
please keep visiting us, because
Yeah,
the
definitely, sir.
kids of the institute needs you more, and we also need you. I am
Yes, sir. I
much
understand
older
that.
than you, but your knowledge is so such encompassing that I would want to learn more from you. So all the best for
Definitely,
being
sir.
very
I'll
bright,
put
and
my time. Yes, sir.
all the best, and my congratulations for being such a bright kid, and just God bless you and do well in your life.
Thank you so
Thank you
much, sir.
all.
Thank
Thank
you.
you, Ankit ji. Thank you, Shaz ji. And thanks all the attendees to attend this session. Bye and take care.
Yeah,
Thank you,
stay safe.
Naveen, sir. Thank you,
Stay safe,
Ayush.
everyone. The corona is getting very threatening. Stay safe.